as always. 4 minutes late by my clock. But I do smell a little bit of opportunity in the air, a little bit of what's he going to talk about tonight. I can see a few people have already guessed it. Great subject tonight, $1,000 for me, says Mike. And there have been some questions flowing in the live chat already. Talk about ASA, fantastic. Jennifer's asked about Australasian Sonographers Association. Well, I'm up here in Sydney. Many of you will know this backdrop. I've been here before. This is our Sydney office. Rask shares an office in Melbourne, as we do here in Sydney. It's a beautiful office, and just looking over there, Wynyard Station in the CBD. But I'm up here because we are part of the Australian Shareholders Association conference that's taking place tomorrow and Friday, and also Selfwealth is too. So Rob, who is behind the keyboard tonight, he will be here as well, and he'll be speaking on Friday. So it's our absolute delight. If you are from the Australian Shareholders Association, if you're a member, even if you're not, welcome to tonight's show. Before I answer some of your questions, and there's a really interesting question that came through from Chef Circle. It's the very first comment I can see on my end, which was about the WIMAX ETF, which is, if I'm not mistaken, a bit of a dividend harvesting ETF. I will get to that in a few moments, but obviously we have to do the wonderful thing that you all rock up for every week. You don't think about me. You don't think about what kind of stock is he going to talk about, what ETF is he thinking about. You all just want to know about the disclaimer, the general advice disclaimer. So I'll get to that in just a moment too. But first, we should start with the serious matters. And the serious matters for this week, the joke. And this week's joke was brought to you by Mel in our team here at Rask. And this is the joke. Apparently, you can't use beef stew as a password. It's not stroganoff. That is a joke. You can give me a score out of 10. I'm guessing it's going to be probably an 11, maybe even a 1. So let me know what you think. Now, this joke, Mel wasn't going to go with it, but I said, you know what, Mel? This is a good joke because a lot of people still haven't activated their two-factor authentication on Selfwealth, I believe, including myself. So it's probably a good reminder to keep the security tight. And without further ado, here's tonight's information disclaimer. So obviously every week we do a bit of a disclaimer for those of you that may be new tonight. It's really important to understand that any of the information that I deliver is strictly limited to general financial advice or general financial information only. The information does not take into account your needs, goals, or objectives, so you should speak to a licensed and trusted financial planner. You can see there on the slide in front of you that I am indeed the founder and the director, the sole director of the Rask Group, which is a corporate authorised representative 1280930 of Waddle Partners, AFSL 383169. You can read more about what Rask can and can't do and what we can and can't say in our financial services guide, which is available on our website. The final thing that I'll add, which is right down the bottom here, which is that the views expressed in the live streams are solely those of myself and or any guests who appear on the show and do not necessarily reflect the views or opinions of Selfwealth. Another thing to keep in mind, and this is particularly important for tonight, which is that I think a disclaimer is one thing, but I think a disclosure is another thing. As you know, many of you will know that I run many big podcasts here in Australia. I'm very humbled and lucky to do that. And I take that with great pride. But one of the things that we also pride ourselves on at Rask is disclosure. And disclosure is really important, but it's not often talked about in our industry nearly as much as a disclaimer is, because disclosure is not mandatory in our industry, in the finance industry. So I could own the share that I'm going to talk to you about tonight, but I don't own it right now. I'm planning to buy it, but I don't own it right now. And my rules at Rask that we've self-imposed say that we cannot buy the shares before talking about it. So 3 days before it, there's a window where we're not allowed to talk about it. It's like a blackout. And also we're not allowed to buy the shares if we have talked about it for 3 days after that. So basically what that means is even though I'm talking about this company tonight, I do not own it. And typically I'll disclose everything to you if I do mention a company that I own. I think that's a really important one. Okay, with that said, we've got through all the legal stuff, which is always a highlight of people's week. I remember Rob a couple of weeks ago texted me and he said, I can't wait for the disclaimer on the 10th of May when you're in Sydney. Just the thought of a disclaimer on the road is just a really good thing for me. So I thought that was great. But in all seriousness, I got a question here that came through from Chef Circle. It is the first one that I can see on my screen. It says, Owen, I have a question for tonight's show. What's your thoughts on a small satellite allocation to WIMAX? And you go on to say, this is an ETF and to make a bit of money / dividend income when the market is trading sideways or weakening. So I'll bring up my screen just really quickly, Chef Circle, and then I'll get into my slides that I've got for tonight. But there are a few of these funds that exist, not just here in Australia, but globally. And they take many different flavors. Now, I didn't expect your question tonight, obviously, on this particular topic. So I'm just going to go down and confirm it's the one that I'm thinking of. So obviously an ETF, it's got a management fee. It's from Beta Shares. You know this. But I want to look at the portfolio holdings because I think it's this one. I'm just going to bring this up here really quickly. Top 20 Yield Maximizer Fund. Actually, I don't think it is this one. So there are a couple of there are a couple of products from the ETF providers in Australia, but what they actually do is they don't just target dividend paying companies. So many of you will be familiar with this ETF, which I talk about a lot from Vanguard, which all it does is it just identifies blue chip Australian shares that pay dividends and it buys them and holds them. That's all it does. And then if a share isn't expected to pay a dividend, it's sold from the portfolio and the ETF rebalances. Very simple, diversified, low cost. Now, some of the ETFs, which they're not actually called ETF. Notice how it says it in the headline. They're not actually an ETF. They're called it's a managed fund. And what this tells you, this is very important. The naming convention of these things on the ASX is imposed by the ASX to let you know that this shouldn't be necessarily considered an ETF because it's more active. Now, it may actually be this one, but let's just have a look at what it does. So the WIMAX ETF or fund, I just used the wrong naming, invests in a portfolio that provides exposure to the largest 20 Australian shares, combined with call options. I'll get to that in just a sec. The share portfolio is passively managed, meaning that the weighting of each security will generally mirror the weighting within the ASX 20 or the top 20. And the portfolio aims to generate dividends, franking credits, and some capital growth. Now, I'll tell you how this actually works in just a second, but it's something else that I want to draw your attention to. So let's have a look at this quick yield here. So the yield, this is the before fees and all this. This is the yield that the ETF would have paid over 12 months, so 11%. So you see that and you instantly think, wow, that's really impressive. But if we go up and we look at the 1 year performance, why would the portfolio be up 4%? And then if we've got a table for total returns, some people get a little bit confused by this. Now, this fund has actually performed quite well. You can see just as an eyeball, you can see it generally from the chart here. But what happens with a lot of these funds, Chef Circle, is a lot of them, it sounds crude when I say it this way, but they kind of rob Peter to pay Paul. So what they do is they take the growth and they put it into dividends. Now, I was chatting to a behavioural finance expert named Simon Russell. He's the founder of Behavioural Finance Australia. I was chatting to him maybe a month ago now. And he said one of the biggest misconceptions that he sees, and it's actually a behavioural finance thing that causes us to do this, and he sees this particularly with retirees, is he sees investors often targeting income because they believe their goal is income. But what they miss is they miss the growth. But they think because the cash that hits their account, they think that that's an effective investment based purely on cash. I was actually talking to Will Colbert from Contact Asset Management. He works with Tom Milner, who you may know. And I was chatting to him about this today, and he said his one rule that they have internally at their business is dividends do not lie. Right, now that is true. Dividends do not lie. If you get a dividend from CBA, it's a dividend. However, if you get a dividend, it's called a distribution, but if you get a dividend from an ETF or a managed fund, that may also include some capital gains. So you're not actually getting true sustainable income. And that's why the performance of many of these funds, Chef Circle, isn't actually as good as what you think. It's only when you look at the total return and you look at the dividends plus the growth that you then see the truth. Now, I've showed you this in the past. So the ASX puts out the monthly note. I think I shared these resources last month, or last week, I think it may have even been. But remember, this report that comes out every month tells you exactly what the returns are from all ETFs, from all listed investment companies, from all M funds, from all REITs, all of that stuff. All those things that aren't shares will be in here. And you can also get it in Excel. And so if we come down here, and I'm just going to do a very quick one. I know I've labored on this point, but I know it's going to be an important one for tonight. So if we go to WIMAX, so if we can see here, I can see it's in here. I'm going to go right across to the side. Sorry if it's a bit small for y'all. I can see over 3 years, it's done 14%, and over 5 years, it's done 7.76% in total return. So we can see this all the way over here, 7.76% per annum. But now let's try and find VHY. So that's just the vanilla dividend ETF. It just targets dividends, and that's all it does, is buys and holds dividend paying stocks. So that's the third from the bottom. This has done, it's right above it. It's done 11% per annum. So the simple one that's just buying into a diversified group of dividend paying companies has done better than the one that does the call strategy and just does the options and does all that sort of stuff. And this is, Chef Circle, a very long-winded explanation to say, I often don't use those types of products for that very reason. Now, you'll have to excuse me tonight. I'm actually having some menthols. I've actually got a bit of a cough lately. So, but yeah, I just want to make sure that you know what I'm putting in my mouth is just a strepsil. So I've got another question, which before I get into my slides, I'll answer this. Jeremy, you say, what about combined with franking credits? Is that just icing on the cake, or is it just not worth it to sacrifice growth as it impacts longer term returns? So, so what happens, Jeremy, with some of these complicated ETFs and managed funds is when they invest money for you, they actually don't earn franking credits. And I'm not saying it's with this one, but some of them don't. And the reason why is in Australia, even if you're an Australian tax resident, you still need to own your investment for 45 days to be eligible for the franking credits. So some of the strategies, not WIMAX, but some of the strategies actually don't harvest franking credits because they aren't eligible legally to retrieve them. So it's something to keep in mind. Okay, so I will, before I just ramble on into eternity, if you are coming to the Australian Shareholders event tomorrow, Shareholders Association event tomorrow, you can come and ask me many million of questions that you want to ask me. But and I'll love it, by the way. But let's get into some of these things. Okay, really good question. Just quickly, MKD247, you've said, Owen, at what point do you start looking at returns and think this isn't sustainable, e.g. dividends / distribution yields above 10 or 15%? I'll answer that really quickly, MKD. So the historical returns is the way to look at this. So if you see a return from any investment and it is above what the stock market as a whole has done for a very long period of time, which is around 10 or 11%. If you go back to 1900, it's 13% in Australia, but say the last 50 years, it's about 10 or 11%. If you see a dividend return that's towards that level, whether it's from a managed fund or a share or something like this, you'd want to question how sustainable that is, because if it was that good, then everyone would do it. There's obviously some risk that you're stacking on top. So that's probably what I'd say there. I'll just have a drink of this water. Okay, so you may remember, it was about 2 years ago, I had COVID and I still rocked up for Selfwealth Live, not to give myself any credit, but I did cough up a lung that night, literally, and it wasn't a happy ending. So I don't have COVID tonight, fortunately, but I'm just not, just got a bit of a cough. So, so here we can see the name of the company that I am about to invest in. And it's a company that someone guessed. I can't remember who it was. Let me just have a really quick look here. Martin said Sol. Who else said it? There was one more. Someone else said Sol Pattinson. Pardon me. But Washington H. Soul Pattinson is the company that I'm talking about tonight. Soul Pats is a business that many of you will know, particularly if you're in the Australian Shareholders Association community. It's diversified. It's a long-term focused capital allocator, and it's a business that I wrote up recently and a person who I interviewed recently. Pardon me. I hope I'm going to make it through tonight while coughing. Okay. So some of you will know this concept of anti-fragile. And maybe while I mute myself and cough for a moment, I would love to know if you, having seen the discussion that we had around about a month ago now, or if you're a shareholder in Washington H. Soul Pattinson, or you've gone around and looked at other companies that you consider to be in this bucket after we spoke about it about a month ago. I would love to know the names of the companies that you think fit into this bucket of businesses that are so strong that they tend to get stronger as they grow. So you may remember, just to quickly jog your memory, we talked about businesses that can actually grow stronger as they get bigger, whereas consensus tends to, and wisdom tends to tell us that there are some businesses, most businesses, and the laws of capitalism kick in to tell us that once a business grows to a certain size, it will then falter. But there are some businesses that get stronger. You may remember this conversation that we had. So if you know of them, I can see some of you have already put that in the chat. Tell me what they are and why you like them. I can see Harry said Wesfarmers could be a similar company. Macquarie, says Jeremy. Paul says Steadfast. Paul, that's an interesting one. Why do you say Steadfast? I would love to know. I'm assuming you're talking about the business and not using an adjective to describe a company. Jenny, you've said I own Soul Pattinson. It's in my core. Sophia said CSL. That's a good one. Now I'm just going to mute myself and cough really quick. Owen said ResMed. That's interesting. I think Wesfarmers is a very good one as well, Jeremy. Penny says Macquarie Group as well. Pip, you've said any company with network effects, i.e. Facebook. Now that's a very interesting thing, Pip. I'll come back to that in just a moment. So there are businesses that I consider, and this is all just our opinion, right? There are businesses that exist in Australia that have these characteristics. Jaden, yes, Berkshire Hathaway, who held their AGM over the weekend. Many Australian pilgrims made it across there to the Omaha, Nebraska meeting, and I believe some Australian investors also took part in the Markel meeting as well, which is the mini version of Berkshire Hathaway. Tooney, you've said Wesfarmers, Soul, and BRK in the core. Okay, I like it. So far, so good. Okay, so to fill you guys in, I mentioned, just as a recap, I mentioned how my personal investing strategy is one where I go anywhere. So I like to think that money can be made in companies no matter where they're found. And I don't just mean that from, well, they're in your Selfwealth brokerage account, or they're on the ASX, or they're on the NASDAQ. I mean, literally anywhere, any sector, any geography. So I think one of the areas where we see a lot of value being created going forward, which has been missed by a lot of investors, is actually in the private market. So companies that you see that you might walk past down the street, but they're not on the stock exchange, but you know they're great businesses. And so my very loose kind of framework and how I thought about this is like, over the next 10 to 20 years, I will begin to invest more of my own money and my company's money in a way that exploits that belief that you don't need necessarily just to invest on the ASX. You don't need just to invest in public securities or companies. You can invest any way you want. whether it's in ETFs, whether it's in index funds, managed funds, LICs, whatever. And you can see how I've just broadly broken this down here. But within that overall bucket of companies and different types of assets I want to own, one thing that I really want to focus on are companies that are anti-fragile. Now, you may remember, and some of you may be familiar with this, but I interviewed a very, very successful venture capitalist not too long ago. And he told me, and this is from a venture capitalist who's probably Australia's most successful. And he said to me, Owen, many of the companies that I started, I don't consider to be a success because the companies that I started do not exist today. So his companies got bought out or they were merged into other businesses and so on and so forth. And so he said that one of my key pillars of success is finding businesses that survive. Now, Washington H. sold Pattinson here. See how it says 1903? It's actually been around longer than that. It's actually since 1872 when it started as a pharmacy just here in Sydney CBD, and it merged with another pharmacy about 20 or 30 years later. That was where I'm sitting, that direction, just over in Balmain. So the two pharmacies merged together, and that's where the name comes from. Washington H. sold Pattinson. It's actually the name of the two different founders of the two pharmacies. And you will know up until recently, like it was a massive pharmacy chain right around the country. Now, another business that I consider to be anti-fragile is this company here, which is a company called Constellation Software in Canada. And it does a very similar thing to Sol Pattinson. It just buys up other companies and then holds them and lets them grow. Kind of like the Berkshire Hathaway, which I've got down the bottom here. I can't focus on it for you, but the Berkshire Hathaway business model is very much the same. So I consider all of these companies to be anti-fragile companies. Now, Caroline, you've said, do you include your own businesses under that investment, or is it just shares? It would include, if I go back to this, I just want to make sure, that would just be my own portfolio. That wouldn't include my own private company, Caroline. So that's something. So, fellow, you've said you're viewing from Werribee in Victoria. Well, fellow, welcome. Jeremy, you've said, do you invest in private companies? Well, I've got my own private company, Jeremy, and to date, we haven't made any acquisitions of private businesses, but it is where I'll probably spend most of my time over the next few years. Because when a business like mine starts and it becomes cash flow positive, so the business itself starts to become cash flow positive, what you can then use your company to do is actually acquire businesses and adjacencies that you can actually add value to beyond what it can add value in its own right. But and that's what Warren Buffett did in the very early days, right? Is he had his pinball machine business, and then he had his paper mill business, and they had synergies in that he could run one on the side and run this one on the side here, and then grow from there. Okay, so he's targeting acquiring the AFR. I don't know about that, Jason. I'm just a small fry, and I don't talk about these things lightly. I just want to give an illustration of I'm putting my money where my mouth is. So there's another type of company that some of you suggested in the chat. Anti-fragile companies, in my opinion, can also take the shape of companies that have some sort of regulatory barrier around them. And Jason, I actually think it was you, I could be mistaken, who last time said PEXA should be added to this list. So these are businesses that can basically be insulated from competition, and they can defy those laws of gravity and those laws of capitalism, and they can actually withstand competition. So that might be a bank or something like this. And I think it was Pip, you said before, that some companies that have network effects can fall into this bucket as well. Well, there are companies that maybe can combine network effects with this idea of being flexible as well. So a company like Netflix, which had the early network effect where more users streaming videos meant that they could invest more back into content and acquiring more users because it's got better content. And the network flywheel just keeps turning. You could say the same for Facebook. But one problem that those types of businesses have, Pip, is that they get to a point where they need to innovate and break their own business. So what I mean by that is, unless they have a culture in place that is constantly forward-looking and saying, what are the risks to our business and how can we grow and beat ourselves at what we're doing, they eventually just succumb to the laws of gravity and plateau. And there are many companies that reach this point. But a really good company that has defied this is maybe a company like Amazon. So Amazon, in the early days, started as a bookseller, and then it asked its clients, well, what can we do better? But Amazon was also the inventor of the Kindle, which is the first electronic book in its own right. And it actually had to force publishers of books to adopt the Kindle. But then what Amazon also did is Amazon then said, well, this whole cloud computing thing, that could be a really big medium and we need to get in front of that. And they built what is now AWS, the world's biggest cloud computing platform, out of something that came purely based out of its agile culture. And we, as a finance profession, we don't really have a way to quantify many of these things that I'm talking about. So we tend to disregard them as kind of wishy-washy, but they're actually real things. And I'm going to break it down into one company in just a second. You can see Stephen's joined from a member email of ASA. That's great, Stephen. Thank you for joining us tonight. Hopefully you're in Sydney tomorrow and we get to meet in person. But so finally, there are a distinct group of companies, and you will remember these. A company, like many of you will know these brands, and it's funny how I bring them up because it's kind of ironic. But many of these businesses, I've put in this category of anti-fragile because they've been so strong that they actually survived the most brutal risk that could have been put upon them, which is this idea of, during the Big Short movie, you may remember that the ratings agencies who put credit ratings on bonds or on properties or on whatever actually did the number one thing that they're not supposed to do, they did, and they got away with it. But not only that, their share price continued to go up and up and up and up. I think it went up 2,400% in the case of S&P. So it did exactly the thing that it wasn't supposed to do. It took the trust of the world and crushed it. That's what it's paid to do. And then it still grew anyway. And that's an example of a business. If you can find those businesses where the worst thing can possibly happen and they can keep growing, they are incredible businesses. And a business maybe which is similar to that in Australia is a company like Transurban, which is the toll road operator. So it's basically got a monopoly on Australian toll roads. It owns toll roads in Melbourne, Sydney, Brisbane. If you drive on the roads in Australia and you go through a toll booth, chances are you're paying Transurban. That's an example of a business that went through COVID and went through all of these different things, and it continues to grow. And that's what makes it such an impressive and outstanding business. Okay, so let's sink our teeth into actually what I wanted to talk about tonight. And I'm sorry to say I'm 30 minutes in already. But you may remember that recently I spoke to Todd Barlow, the CEO of Washington H. Soul Pattinson. And before that, I spoke to Rob Milner and Tom Milner and a few others that are in and around the Soul Pattinson business. And I'm going to break down why I think this company deserves a spot on a watch list. But before I do that, I want to insert a warning and just say that it's really important to understand that, in the subject line for this video, you can see it in the title of the video here, I said I would invest $10,000 in this company. But it's really important to understand that would be going into a diversified portfolio. That would be going into my portfolio, and I understand what I'm doing. So if you're a newer investor, don't take the number that I put in the headline, or don't take all of that and think, well, I should go and do this. I'd highly encourage you to go and research these businesses for yourself. And if you're new to researching businesses, or if this is your first evening with us here at Selfwealth Live, what I would encourage you to do is to go in the back catalogue and look at all the videos on the YouTube channel and explore those. But some of you will have also asked, and Rob and I chatted this week about some of the resources that we give to you every week when we do the shows. And many of you go and you take these resources and you use them. And one of the things that I've brought up in the past is this checklist, this investment checklist, which some of you may remember. And here you can see, this is the checklist that we developed as an analyst team at Rask, right? And this is the checklist that I broadly follow when I'm looking at companies. You can take this checklist, right? I said to you in the past, it was only available for our students that pay us, but I've actually created one that isn't quite as fancy, but it's the same one. It's exactly the same one. Just doesn't, when you click it, doesn't do all this certain things. And you can actually access, this is in the description for the video. If you just look below the video, don't click it now because you'll get taken away from the video, but you'll see it there. And you can actually download this file. I can see a few of you are in here already. You can actually download this by clicking File, Download, and download it as Microsoft Excel, and you can use it yourself. But this is the checklist that we follow to find companies. And I'm going to tell you why this is important in just a minute, okay? This checklist. I'll just put it in Rask checklist. There we go, Rask checklist. Right, so that's in there. So you know that's it. That you can access that after the show if you want. So, so if we keep going down, you'll know there's this interview that we conducted with Todd wasn't too long ago, and you'll see all of that. The writing on my hand is because, remember, I ran out of a piece of paper, so I had to write everything on my hand while I was doing the interview with Todd. He's a wonderful CEO, by the way. Really impressive. Okay, financial freedom. You said you've been using it. I love the summary of how much is completed at the top of each sheet. Yeah, great. Wonderful. So good. That's great. I'm glad you got some value from that. Okay, so what does Washington H. Soul Pattinson actually do? I'll explain this before I'll explain how this all ties into the checklist in just a moment. So Washington H. Soul Pattinson, I'll see if I can zoom in a bit here. I can't. The more I zoom in, the more it zooms out, which is a bit of a funny old thing. I wonder if I can go like, no, it's not going to work for us. Sorry, guys. But unless I do this, watch me, and then you get a big ugly shot of my face. So sorry about that in advance. But if we go like this, okay, so that might be a bit better for us. Okay, so the Washington H. Soul Pattinson business is basically split across all of these different divisions or segments, which is what we call them in accounting. And here we can see most people know Soul Patts for its investments in companies like Brickworks, TPG Telecom, Tuas, which is the Singaporean version of TPG Telecom, pardon me, or even New Hope Coal, which is the coal mining business. But it also has a tremendous portfolio outside of that of different businesses that it is looking to build. And two of those businesses in particular that I want to draw your attention to are the structured yield, which is something people don't understand very well, and also I guess not so much the private equity, but the structured yield portfolio and its large caps portfolio up the top here. Now, one of the things that I think we'll see from Soul Pattinson over the next few years is that we'll actually see this business grow, these two businesses grow substantially versus some of the others. But just to give you a summary, so Washington H. Soul Pattinson can invest in other businesses, just like a listed investment company could. It will also buy whole private businesses, so it buys the entire company and then takes them and then puts them on the ASX and releases them into the wild. It has a very small property portfolio, but that's mainly done by Brickworks, which is one of its shareholdings, not so much it. It does run its own portfolio, so it invests its own money, just like you invest in your own money, it invests its own money. It's got a merging company portfolio. So again, this is where it just invests in small cap companies. And finally, it's got the structured yield portfolio, which I'll explain really quickly. So a structured yield portfolio is very much finance talk for a part of its portfolio where it simply just invests. It provides capital to other businesses. So if a business owner wants to grow its business and it needs $10 million to go and make this acquisition of something like a new facility or something like that, you could go to Soul Patts and Soul Patts would earn interest on the $10 million that they give to them. Really simple example, but there's a lot that goes into that. Reggie said, Cole would stop me from investing. A lot of people do get put off by Washington's or Sol's exposure to coal, but there's a very good case to be made, and I'd highly encourage you, Reggie, to go back and listen, if you haven't already, to that interview with Todd Barlow, because he actually explains how they think about it. And even if you don't agree, it's just a variant perception, or one of the things that I find very much encourageable amongst anyone in life, but particularly investors, is to get the other side of the debate to then make the decision, even if they're wrong. Because in investing, unlike in a lot of life, it doesn't matter who has the right belief. It actually just matters who's right. And I'm not saying that that's like always like financial outcomes that determine what's right or wrong, but I find that open mind. And by the way, the coal aspect for me is a very big put off as well, but I was still investing for the reasons that are outlined in the podcast. Okay, so Fleur, you've said, I love the imagery of releasing them into the wild when I talked about these private companies. So it's actually, it actually is a true thing. So if you think about the way, I'll just go to this slide and turn that off really quickly. If you think about what a lot of investment houses do, is they basically take the young business, they nurture it and let it grow up inside their support, and then they release it into the wild. And what I mean by that is they release it onto the ASX and they say, here you go, ASX investors, take this thing from us. And then that's when they make their big money. That's what a lot of private equity funds do. But the difference with Sol Pattinson to a private equity fund is that they don't typically, they do it in, let's say, in a way that's ethical, in a way that's morally right and long-term focused, say, versus some of the private equity funds. Okay. So this is where it ties into the spreadsheet that I was going to talk about before. So you will remember in this spreadsheet, the way I designed it and the way the Rask team designed it is that we spend a lot of time. In fact, all of this is about, well, nearly all of it is about identifying great businesses. So it's not about finding statistically cheap companies, companies with big dividend yields, none of that stuff. It's actually just about identifying businesses that have the long-term staying power. It's got, like, we don't, in any point here, I don't think we actually ask what's the share price or something like that. What we're trying to find are businesses that have enduring features that enable them to keep growing. At the very least, as Warren Buffett might say, we don't look for the things that will change. We look for the things that will stay the same. And the idea is that if your business is still around in 10 years or 20 years, chances are it's going to be a success. Because by the very nature that most businesses fail, being around in 10 years is success. Going back to the point about venture capital before. But you'll notice if you go into the spreadsheet that a lot of what we do is about the business and what defensive qualities it has. Now, when we look at a company like Washington H. Soul Pattinson, people say, and this is the big disagreement in the investment community, is, hold on a second, you're investing into a company that just invests shareholders' money. There's no competitive advantage. It's just a company that's set up to invest in other companies. Like, there's no competitive advantage. And that's because a lot of the financial and investment profession don't yet have a tool or a framework to think about how do you quantify great people? How do you quantify what it means to have a long-term perspective? How do you quantify culture? How do you quantify, like, all of these things? And as a finance profession, we've definitely gone into the realms of trying to tick boxes and put numbers to things. And many of I believe, the frontier of what we do as investors is not actually trying to be the one that thinks of the number fastest or has the fastest computer. Because if that is our strategy, then there's ChatGPT and there's, GPT-4 and there's all of these artificial intelligence and computers to do all that stuff. If if that is what we think is our competitive advantage in investing, like as investors, I would say we could probably give up now because it's not going to work. So the only thing that we're left with as individual investors is basically this idea that we can master our own behavior and make sensible long-term decisions based on what we know tends to work. And some of those things are like finding great people, letting them run a business, and making sure that business is solving problems for their customers and delighting their customers. Or as Charlie Munger would say, in this business, we've made a lot of money not by seeking brilliance, but avoiding stupidity. And loosely translated into English, what that means is instead of trying to find the company that kicks it out of the park and ticks all the boxes, just try and find the business that avoids you losing money. So let's get into this, and I'll tell you what I think Washington H. Soul Pattinson's competitive advantage is, and then you can use this list to determine in the future if it's time to sell it. So I think that this business's competitive advantage is that it is cross-share-held. So when you look at Soul Pattinson, it's a $11.6 billion company, right? Well, a big part of this business is actually Brickworks is BKW, isn't it? A big part of this business is Brickworks. It's the biggest shareholder in Brickworks, and Brickworks is the biggest shareholder in Soul Patts. And what that actually means in practice is that because the relationship between these two entities is so close, the Soul Patts team doesn't have to worry about its biggest shareholder saying, hey, you're doing the wrong thing. I'm going to fire you, Mr. CEO or Mrs. CEO. You're out of a job. And what it basically means is it protects the Soul Patts business and allows it to invest long-term when all of the financial industry wants it to think short-term. So it can't be influenced by outside investors who want to control its CEO or control the board of directors, because Brickworks wants what's best for Soul Patts and Soul Patts wants best for Brickworks. Now, this has some fund managers have tried to break up this cross-shareholding at times, and it hasn't been successful. Second, the legal structure of Soul Pattinson is interesting. I know we're not all interested in studying the law, but let me just break down what this means. So because Soul Pattinson is a company and not, say, like an ETF or an index fund or a managed fund, it basically means that it can lock in and it can hold its profits and reinvest them again and again and again and again and again. And from a tax perspective and from a legal perspective, that is far superior to having a trust, which is what an ETF is, by the way, where you have to distribute all the profits. You have to distribute the capital gains, because it basically keeps money in and, again, allows Soul Pattinson to think long-term. Number three, and this is to Reggie's point, a great point you mentioned about coal, and Trevor, you agreed. So Soul Patts was able to invest in a coal mining business, help clean it up financially, operationally, all of these things. And it made a huge windfall gain. I think, I could be mistaken, but I think it was a $250 million investment, I think. Now, I don't know. And I think they had a $1 billion return. So I think they 4x'd their money, a 400% return. But then what they did is they sat on the money for quite a few years. Now, if that was an ETF, it would have to be paid back to investors. But they sat on it, waited for the market to fall, and then they redeployed that capital in other investments which weren't moving in the same direction. So in effect, what you had is a business that had the legal structure, which meant it didn't have to pay out its investments. It could make an investment in a different asset class or a different type of thing at a time that was contrarian, which is very rare. Normally what you see in our industry is you see professional investors just investing in whatever's hot at the moment. Now, I won't bore you too much more with some of these things. Trevor, you made a great point here. So Trevor, you said arrogance can also be in such structures. Stephen Mayne has a short shrift for asking reasonable questions at their AGM. Yeah, there is a case to be made for that, Trevor, for sure. And I think scrutiny is always important, right? I think scrutiny is always important. But I think one of the things that I've kind of found comfort in, which is that if you look at the long-term performance of the Sol Pattinson business and what it's delivered for shareholders, I think that's truly impressive. I think that's truly impressive. In fact, it's probably the best in Australia. Maybe not the best, but one of the best in Australia. And so I think this structure has worked for the most part. It's just in the short term, the structure may not work for some investors who seek shorter term outcomes. But scrutiny of everyone is definitely important. Hence, the Australian Shareholders Association. Number 4 is a low-cost mindset. So a lot of people don't invest in individual fund managers or whatever because they think that the business itself is too expensive. So we know, and I think I've got the bell curve. This is my old slides from last year, so you'll have to apologize for. This is the 2022 version of Owen on Selfwealth Live. He didn't have a creative bone in his body, but I'm sure he's with us still. You could probably say, judging by some of the slides. But there's actually a slide that I wanted to show you, and as usual, is this it here? So you may remember that I've showed you this slide a few times, which basically shows the impact of fees. So typically index funds win against other types of investors. So index funds like the Vanguard funds and the BlackRocks and iShares and the Beta shares and all that sort of stuff. They typically win based on fees alone because it moves the entire sample. So when you see those studies that show that index funds always win, it's really important to understand what goes into those studies. And one of them is just like the impact of fees, which is a fair thing. But one of the things that Todd told us during that discussion was that they believe that the effective cost of running Sol Pattinson is around about 0.3%, I think, which would put it in line with most ETFs, yet it is a fully blown company. And that's because even though Washington H. Sol Pattinson is an $11 billion company, they have less than 50 employees. So I think it's down the side here, 47. No, less than 50 employees. How many $11 billion companies do you know that have less than 50 employees? I know companies that are probably $2 million companies that have 50 employees in terms of what they're worth. So this low-cost mindset is actually one of the reasons that it has a competitive advantage, because by having this internal ethos of let's save money, let's do the right thing by our shareholders, that is such a hard thing to do when you have a professional CEO, air quotes, professional CEO, that in our industry, whenever I say professional CEO, what I mean is someone who is basically a gun for hire, a CEO that's built just to deliver short-term outcomes for their board and earn bonuses. And finally, the Washington H. Sol Pattinson businesses have an owner's mindset, not just from the chair and the family behind it, who is still involved today, but also through the executive team who invest in the business and the staff. The culture is what we're trying to capture here. So this is the key point, guys, and I know I've labored on this for quite some time. Any one company on the ASX probably has one of these things going in its favor. It probably has a good shareholder. It probably is a company and it probably has the right legal structure. It may even be able to have a CEO or a team that run the business that think, we're going to do something different to what everyone else is doing and grow. Or maybe they have a really good focus on cost and their business is run on low cost, like say like Flight Centre, which has a pretty good focus on costs, or other businesses, plenty of other businesses, like BHP, for example. Or maybe there are businesses that have a founder, which statistically, founders and families outperform non-founder and family businesses, run businesses. And maybe there are businesses that have one or two of these things, but there are very few businesses, at least that I've come across in Australia, which have all 5 of these things put together. So I think collectively, these are the things that enable us to believe that Soul Pattinson has a competitive advantage and enables it to keep growing. So you may remember that when we talk about long-term investing and using checklists and developing an investment process, one of the really important things to remember is that you need to know when to sell. So it's not just good enough. We're all great at buying stocks. Let's just imagine we've got our core portfolio that's built of ETFs or blue chip shares or listed investment companies or managed funds. We've got a core portfolio, and then we've got these little investment holdings around the outside, which might be small cap stocks or the WIMAX ETF if you're so inclined, or whatever, not an ETF. But what we tend to do is we tend to end up being what we call collectors. We tend to end up with a portfolio of stocks, 20, 30, 40 stocks, and we tend to become collectors of these stocks because we don't really have a strategy. We don't really have a strategy for them. And another thing that people don't really do within that strategy is they don't really have a sell discipline. They don't really know when to sell a stock. And there are many different reasons that you would sell, like valuation, it gets too big in your portfolio, you lose interest, all valid reasons, sure. But one of the things that people don't do is they don't set their rules in advance for reasons that they would sell. Now, if we go back to the screen, here's one way to think about this when you develop your investing strategy, is if there are reasons that you can put down on a piece of paper for reasons that I'm buying this company, 1, 2, 3, 4, 5 in this instance, here are the 5 reasons I think this is a great business. You know, then when you reflect on that in the future and you go, oh, should I sell this business now? You can say, well, reason number 1 is no longer a valid thing. Reason number 2 is no longer a valid thing. So then all of a sudden your thesis is broken. And you can say, well, I don't believe the business has a competitive advantage anymore. And that's a reason that I would sell. And a lot of people don't really think about this in advance, but I just want to bring that into the conversation tonight because I think it's a really important thing when you think about, okay, Owen, well, you're telling me that this is a good business. How would I know when it's right to sell it? And there are reasons for, like I said, at your portfolio, you might say, it's too big of a position in my portfolio. I need to diversify. I need to sell it for other reasons. Maybe it's like I've lost interest in investing, or there's tax reasons, or whatever reasons, those reasons. But you can also take your thesis or your reasons for owning it and spin them on their head and say, well, when they're no longer true, that could be a reason that I sell. Okay, so I've got a few more things, then I'll just open it up to some more questions. When I do a valuation, I won't bore you to death with how I do it, but for a business like this, I would do it based on the dividends. My valuation is basically what is the future cash flow of this business, but to me as an individual investor, that's how I calculate. So what are the value of those dividends? And we've got tutorials online that you can just search for, like Rask dividend valuation models, and they'll pop up and you can download things. Harry, you've got a good question. I'll get to that in just a sec. And this is, so just in summary, Washington H. Soul Pattinson, I think, is well run. I think it's got a great business strategy of buying and holding companies, but also in the future, these other business units will start to take flight. Now, they won't be a huge part of the portfolio to begin with, but over time, I'm convinced. There are different types of companies that I like to buy for the satellite of my portfolio. And one of those is holding companies that I believe are anti-fragile, because you get diversification through those companies. Other companies that have like regulated profits. I like flexible companies, so a lot of technology companies go into my portfolio. I like businesses that have survived some pretty scary times, or at least I think can survive some scary times because it shows resilience in their business model. And of course, one thing I didn't include here is I still use ETFs for my core. I still use index funds. I still use all those things. But if it's individual companies, I'm trying to slot them into this framework. And one way you can do that is you can use the checklist that's freely available in the episode description, in the video description just below. Okay, so I've got some questions that come through, and please, guys, maybe I'll be here for another 10 minutes if Rob forgives me. You know me, I usually like to go late. Start late, end late is the basic rule. But I can see here, Harry, you've said, what is a DSSP and what does it mean? So a DSSP is different to a DRP. So it's one of these interesting things, but most of you will know that when you get dividends from a company, you can elect to have those dividends reinvested back into the company's shares. So instead of getting cash, you get more shares. Perfectly valid thing to do. But there's this particular group of companies, and the AFIC listed investment company, AFIC, and I think ARG qualify for this. There is a particular set of companies that run something called a DSSP. And this basically means, just in very short language, you should speak to your accountant and speak to the company. But what it basically means is that the tax that you would pay on that dividend, so even though you're converting your dividend, your cash dividend, to new shares, you still pay tax on that. So if I say own Soul Pats and I get a dividend and I say, no, I want to receive that as shares, not as a cash dividend, I still have to pay tax because it's still a dividend, right? A DSSP allows you to defer that tax into the future. So it's adjusted into the future. But here's the rub, right? You don't get franking credits. So look into the company. The AFIC has a big thing on their website. You can Google it and it will come up. So that's one thing to keep in mind. Okay, so that's a good one. So Owen, you've asked a question here. What focus do you put on return on equity? And then you go on to say, well, what value do you put on return on equity actually? Good question. So return on equity, just so we know, we're all on the same page. Return on equity simply measures the company's profit against the shareholder equity on its balance sheet. So if a company makes a profit of $18 and it's got $100 of shareholder equity, it's 18%, $18 on $100. Now, some professionals believe that the return on equity is the most important metric because it actually tells you what shareholders are getting for, that the company's performing. But the problem with this is return on equity doesn't adjust for companies that are taking on lots of debt. So a company can juice its return and it can have a return on equity that looks good, but it doesn't tell you exactly what's on the balance sheet. So the metric that I prefer, and I think you can use for more companies, is return on invested capital, ROIC. And you can pull this up in your Selfwealth account, just like that. It's under the ratios tab there. And what this tells you is it just tells you the percentage return, but not just on the shareholder equity, but on the debt as well. So companies that use lots of debt, it will tell you, and it's more comparable. You can use it across more companies. Space Monkey Mojo said, not sure if this has been asked. What's the difference between investing in Sol and VAS? You said Sol tends to have 100% franking and VAS has a higher yield, although it is also more expensive. That's a great question. I didn't cover that at the beginning. So Sol Pattinson, the company, SOL, which you don't ticker symbols, and VAS, which is the biggest ETF in the country. VAS is an ETF, Sol is a company. So there's another major distinction I want to make here, is that VAS, the ETF, only invests in the top 300 stocks. So whatever those top 300 stocks are, it's an index fund. It just follows whatever's in the index. The top 300, we buy those. Sol Pattinson is an actively managed investment company. So it actually identifies which companies it wants to buy and whether those are stocks on the stock market or whether they're whole private companies. And so what you're paying for is you're actually paying for actively managed in a team of people to identify companies or shares to invest in. Now, you can do this multiple ways. There are other ways of doing that. You can use a fund manager, so you can use a managed fund. But again, it's a bit different because with those, it's not a company structure that's underneath, it's a legal trust. So those are some of the different things. Okay, so I'll answer a few more questions. Okay, so Penny, you've said, I'm 30% up on my sold shares, bought less than 12 months ago. Wow, well done so far. Early days, but well done. Wish I'd bought more at the time. Want to buy more, but not sure now is the right time given the current price. I can't actually tell you what to do, Penny, given the rules, obviously, in Australia, as you know. But what I can say is that in my mind, I think a year is a very short period of time for a company like Soul Pattinson. And I can show you, I think I've got it in my slides from last year. I'm just going to have another one of these minutes. I think I've got it in here from last year. We did so many good sessions last year on Selfwealth Live. Every Wednesday night, if you're new here, we go live and we talk about all different types of topics. And I'm just going to try and find the one episode, the one slide out of 300 or 400, 500 that we actually want to talk about right now. Some of you will know the slide that I'm trying to find. Let me find it. Is it? No, that's something else. That was us trying. That was me trying to tell you, don't believe what you read. Don't believe what you read, because obviously they were wrong. Okay, so what happens in the short term? So what I mean by short term, I mean like 1 to 2 years, is a business's strength, like on the stock market, in the short term is basically impossible to predict. But the longer you invest in a company, the more it begins to reflect the true value or fundamental value of a company. So say, for example, I buy Washington H. Soul Pattinson shares tomorrow. Company goes up to $35. That's 10% from here. Does that mean the company's 10% better tomorrow than it was today? No. And some of the data is still a bit patchy on this, but basically what it suggests is that it's not until you get to really 10 years or 5 to 10 years, and this study was done by Boston Consulting Group, and it shows the top performing companies over 10 years and what statistically explains their performance. And what basically this suggests is that it's actually the growth in the company's sales and the growth in the company's financial performance, not the stock price, which determines whether or not it's a good investment. But in the short term, it actually is the share price just randomly fluctuating and based on what we call, in this instance, based on what we call the sentiment. So what people currently think of the prospects. So what I would say is that when we look at long-term investing, the longer we look out into the future, the less important today's valuation is. However, there is also a point where too high a valuation is just crazy. And I think you may remember, because I didn't share it here. I'll show you what our members saw. That's RAS members, by the way. I'll show you in my original research report what they saw. So I'll see if I can zoom in here a bit. So this, you can't really see this chart right here, but basically what this chart shows over time is it shows the price to book ratio. So this shows the share price compared to the value of the assets inside Soul Pattinson. So this just basically compares the share price to the value of the company's assets. The higher it is, the more expensive it is. The lower it is, the cheaper it is, right? And what we can see here over time, this is over a very long period of time, is that it was recently when the company's valuation got stretched. So people were maybe at risk of overpaying. It was stretched. But recently it's fallen way back down, and it's probably in line with its historical average. This was based on a few weeks ago. So what this basically suggests is maybe people are slightly overpaying, but for the most part, maybe it's maybe slightly expensive, but maybe it's not drastically too expensive. I hope that makes sense. Okay, so Sparky, you've asked one final question, which I'll answer right here, which is, do you consider SOL a core part of your core portfolio? The answer is, Sparky, that I think it could go into either. I've done a lot of thinking about this over the past few months, and I think it could go either into the shares part, the Australian shares part of my core portfolio, or into my satellite. I probably treat it as a satellite position right now because it's an individual share. But that's just how I think about it. I think it could also be like a discrete shareholding that someone has off to the side and plans to hold it for a few years just to see how it goes. So I hope that's my kind of wishy-washy answer, but I don't really have an exact answer because I think it depends on what the investor's strategy is. And for me, you know, like for me, if I invest a small amount of money today and I keep adding to it over time, I think that it could be in my core portfolio or it could be in my satellite. I think if I take a 10-year view, where will I be in 10 years? Fingers crossed I'm still here, touch wood. But in 10 years from now, I think it would be a small part of my portfolio because I think between now and then there'll be other things that grow in the middle of it. And so therefore it's probably going to end up being a satellite position, but I could happily build a bigger position in it as well. Penny, you've said, I think it is core for me from my perspective. Yeah, great. Anthony, you've said, if you never plan to sell it, is it a core? Yeah, probably. I mean, it's not a business that I would never sell. Like there would be reasons, and I outlined some of them there, why I would sell. Or if, for example, the Milner family left the company for whatever reason, or if they really just started to make some bizarre acquisitions, I would sell it. But they're not very strong reasons to sell. It would take me quite a while. It would probably take me many months or years to even just once I have the idea of selling to actually go through with it. Because I'm typically slow to sell, too slow to sell in my history. So it could be either. But like all things, whether you're just starting your investing career or whether you've been going for 50 years, I think it's always with new positions, it's important to start small and just slowly get comfortable with the business. Like it takes me years to get comfortable with a company. I've been following Washington H. Pattinson since 2013. Maybe owned shares once before, maybe in the very early days. I'm just annoyed it took me this long to start making a position in it. But I think one of the things that I really need to do was just to hear from the CEO. I've now spoken to Rob Milner, Tom Milner, Todd Barlow, and a few others in the team over the years, and they all sing from the same song sheet, and it's really impressive. And I think I just needed that to get comfort with what they truly be, because their competitive advantage is their culture and the way they like all move in lockstep. It was very hard for me to get comfort with that. Like I think I showed you guys, maybe it wasn't in the live program, but I mentioned a few weeks ago, I can't remember who it was to, that a lot of the researchers that I follow believe that Washington H. Pattinson does not have a competitive advantage. So for many years, I ignored it just based on what everyone else was saying. And I didn't have a strong enough reason to say, no, I think you're wrong for these reasons. But now I think I do. So now I finally come around to it. But it took me years to get to this perspective. So, Owen, you've said it's it's a core position, but I'm still not buying it. More ETFs. Yeah, great. More ETFs. Fantastic. Caroline, you've said, I overpaid when I bought my Australian Foundation investment, LIC. I keep telling myself it won't matter in 30 years. Yeah, maybe it won't. My old colleague, Scott Phillips from the Motley Fool, he's a great investor and great thinker. And he says, like, he would say something like, I don't think I've heard of anyone who's come back after 10 years and said, I wish I paid a few less cents. So yeah, I mean, it's one of those things in investing where we get very hung up on it in the short term. But I just truly believe if we are long-term investors, so not just 1 to 3 years, but like 5 to 10 years, far more important to spend time focusing on the business than the actual the price earnings ratio of the dividend yield today. So Simon, got to love the Milton and Sol merger. Yeah, it's a big one. Fascinating. Okay, guys, I will say good evening because we are getting up early tomorrow morning. Rob is presenting on Friday. I'm presenting on Friday as well, the Australian Shareholders Association, and we've got to set up for the conference, which is going to be heaps of fun. So I think thank you everyone who joined us, particularly for people from the ASA who have joined us for the first time tonight. We do this every Wednesday night. Rob and I from Selfwealth, so Rob from Selfwealth, myself from Rask, and the community here. We all get together and we hopefully will do one of these in person ourselves in the future. We'd love to do that. But thank you. And 6 a.m. flight for Rob. It's a 6 a.m. flight for Rob. Well, Rob, yeah, you might have to chat to Kath, the CEO, to say, can I get a later flight next time, please? It's quite late, quite early, so a bit too early for me. So without further ado, I will see you all next. Hit like, people, says Jason. Hit like, give us a thumbs up. I will see you all next Wednesday. Don't forget, we've got the value investing series coming up in June, where we're going to have some of Australia's best value investors on the show for 4 weeks in a row, leading into the end of the financial year. And between now and then, it's you and me, and there may be a fund manager or two that drops in every Wednesday night. So maybe even Mel. Mel might even drop in from the Rask team. So we'll see. Thank you. Thank you, everyone, for joining us tonight, and thanks for the great questions. Johnny, thank you from the Solomon Islands, he says. Johnny, thanks for joining us all the way from the Solomon Islands. Panasonic and Rest, as Jen. Yeah, I'll be taking it easy tonight. Don't worry about that. All right, thank you so much, everyone. We'll see you in 7 days, or hopefully tomorrow or Friday.